This AI-generated podcast is for general information only and does not constitute financial or legal advice. Please consult a qualified professional.
Welcome to the Luxembourg Fundcast, produced by Bertrand Mariaux, a regulatory lawyer qualified as Avocat à la Cour in Luxembourg and Paris. This show brings you reliable insights on Luxembourg regulations sourced from curated official references. This episode is current as of 27 May 2026. Okay, so say you have a private banking client sitting across from a relationship manager, and this client holds a highly liquid securities portfolio, let's say worth 5 million euros.
Right, a very standard scenario.
Exactly. And they need a quick bridge loan of 85,000 euros.
Okay.
Now, under our current operational standards, processing that request is, essentially a commercial formality. You secure a pledge against the portfolio, draft a standard facility agreement, and the funds are advanced.
Right. It's fast, it's efficient. But starting on November 2026, handling that transaction the exact same way will trigger an immediate, direct regulatory breach. The math of Luxembourg private banking is undergoing a fundamental mechanical shift. We're moving away from pure asset-based comfort towards strict cash flow-based consumer protection.
I mean, that 85,000 euros instruction is really the perfect operational stress test for what we're covering in this deep dive.
Yeah.
And you mentioned the date, which is the overarching anchor point for your internal credit workflows.
November 2026.
Exactly. That is the date you must retain above all else, November 2026. That is when the new European Consumer Credit Directive, widely known as CCD2, becomes fully applicable.
Right.
The core legislative mechanism here, which is processed through Luxembourg Bill 8708, expands the strict consumer credit scope. So we are moving from the current range, which captures loans between 275,000 euros, to a much broader net.
And that new net captures everything up to 100,000 euros, right?
Yes, from €1 all the way up to 100,000 euros.
Right. Okay, so that seemingly routine 85,000 euros loan suddenly gets swept into a highly regulated operational category. And we are dedicating this deep dive to the specific internal mechanics of that transition.
Right.
Our mission today really revolves around 3 non-negotiable takeaways that you need to integrate into your systems. Number 1, the absolute mandate to classify the credit accurately before the first draft of any document is generated.
Crucial first step.
Right. Number 2, the operational requirement to prove the borrower's repayment capacity independent of their pledged collateral. And number 3, calibrating your documentary record to ensure complete compliance conformity.
And the sequence you just outlined is strictly linear. I mean, you cannot calibrate the documentation if the repayment capacity analysis is undocumented.
Makes sense.
And that capacity analysis will be legally flawed if you haven't applied the correct regulatory classification at the very start of the workflow.
Okay, let's pull apart that first step then. The classification mandate. Because under the current Luxembourg regime, a lending professional, let's say a credit institution operating under the 1993 law on the financial sector, they have distinct regulatory paths when lending to an individual.
Right. They have to categorize the facility as consumer credit, mortgage credit, or a general commercial loan falling outside those specific consumer protection chapters.
And those general loans are typically governed by Article 28-4 of the 1993 law.
That is the foundational triage process, yes. Currently, Article L 224-3 of the Luxembourg Consumer Code provides a very clear carve-out. If a credit agreement is below 200 euros or above 75,000 euros, it sits entirely outside the strict consumer credit rules.
So your 85,000 euros private banking loan defaults to that Article 28-4 bucket.
Exactly. It requires standard professional diligence, of course, but it is shielded from the heavy pre-contractual disclosures and mandatory withdrawal rights that are dictated by the Consumer Code.
So that is essentially the speed limit we've all been driving under. But Bill 8708 changes the signage on the highway, essentially. It removes the 200 euros floor entirely.
Which means a 50 euros overdraft is now in scope.
Right. And more critically, for wealth management and private banking operations, it raises the ceiling from 75,000 up to 100,000 euros. So everyone who's driving legally at 85,000 euros yesterday is going to face a compliance nonconformity tomorrow.
Unless they recalibrate their internal engines.
Right.
And that recalibration is substantial because shifting a loan into the consumer credit scope is far more than an internal labeling exercise.
What does it actually trigger?
Well, the moment that 85,000 euros instruction is classified as consumer credit, a highly structured set of mandatory requirements activates. The lender is legally obligated to provide the standard European Consumer Credit Information Form, the SECCI.
And that has to happen before anything is signed.
Well, before the client signs anything. You also have to guarantee a 14-day right of withdrawal. You have to adhere to specific advertising and disclosure standards. If the origination team just assumes it is a standard Article 28-4 Lombard loan and skips the SECCI.
The contract is fundamentally flawed from day one.
Exactly.
Which, that introduces significant friction into the relationship manager's workflow because a client asking for a quick 85,000 euros liquidity bridge, they don't want to wait for standardized pre-contractual forms.
No, they don't.
They certainly don't want to hear about a 14-day withdrawal period. They just want the funds. But the legal reality dictates that front office speed must yield to back office compliance.
Right.
And that brings us to the most complex operational hurdle, which is our second core takeaway, the requirement to prove repayment capacity. Because once you realize the 85,000 euros loan is governed by CCD2, the entire underwriting philosophy changes.
Yes.
You cannot just point to the client's assets anymore.
No, you can't. The regulatory philosophy driven by the CSSF, the Commission de Surveillance du Secteur Financier, and the EBA, the European Banking Authority, has fundamentally shifted. The overarching policy objective here is responsible lending.
Right.
And the prevention of consumer over-indebtedness regardless of the borrower's apparent wealth. The days of pure asset-based lending where the underwriting file just simply lists the value of the pledged securities.
Yeah.
Those are effectively over for loans falling into this new 1 to 100,000 euros bracket.
Okay, I really want to press on the mechanics of this because it's where the theory of consumer protection really collides with the daily reality of private banking.
Let's do it.
Let's go back to our high net worth client with the 5 million euros liquid portfolio. They want 90,000 euros to, buy a luxury vehicle or fund a short-term project. From a pure risk perspective, the bank is entirely insulated.
Economically, yes.
Right. If the client misses a payment, the bank just liquidates a tiny fraction of a blue-chip stock portfolio. The loan-to-value ratio is minuscule. So why does the law force the relationship manager to sit down with this ultra-wealthy client and audit their monthly expenditures, their utility bills, and their cash flow?
Because under the EBA loan origination guidelines, liquidating the collateral is viewed as a failure of the loan, not a feature of it.
Oh, wow. Okay.
The directive is specifically designed to protect the consumer's assets. So if a bank grants a loan knowing the borrower lacks the monthly cash flow to actually service the debt, forcing that borrower to liquidate their primary assets or default is considered irresponsible lending.
I see.
The collateral is merely a secondary safety net for the institution. It mitigates the loss given default. But it cannot do the legal work of proving the borrower's primary repayment capacity.
So the CSSF and EBA frameworks essentially dictate that collateral supports the credit, but it absolutely does not replace the borrower analysis. Even if the bank has zero economic risk, lending purely against the pledge without verifying ongoing cash flow is a violation of prudent lending standards.
That is the exact legal mechanism. The creditor must verify the borrower has the actual ongoing financial means to repay the credit from their regular income streams.
Like what specifically?
Whether that is salary, documented dividends, or stable investment income. And they must calculate this against the borrower's existing liabilities and regular expenditures. You cannot just assume repayment capacity. You have to document the mathematical proof.
And that mathematical proof isn't just a static snapshot of today's finances, right? The underwriting team actually has to project into the future using sensitivity assumptions.
Right.
So if I'm taking out a 90,000 euros bullet loan backed by a portfolio, the bank cannot just assume I will sell assets at maturity to pay off the principal. They have to stress test the structure.
Yes, and the stress testing requirements are highly specific. The loan origination framework demands that you model adverse scenarios based on the structural features of the credit.
Okay, give me an example of that.
Well, if it is a variable rate facility, the bank must calculate whether the borrower's cash flow can still absorb the monthly payments if interest rates spike by a significant margin, say an increase of 200 basis points.
And what if we introduce cross-border complexities? Because, that is standard operational practice in Luxembourg.
Very common, yes.
Say the client's income is in euros, but they want the 90,000 euros facility denominated in Swiss francs to match a specific investment strategy.
Then the sensitivity analysis must account for foreign exchange risk. The underwriter has to model a scenario where the euro depreciates heavily against the Swiss francs, which would significantly increase the relative burden of that debt service.
Right.
If that modeled currency shock pushes the borrower's debt-to-income ratio past acceptable limits, the loan cannot be proved purely on the strength of the collateral.
It fails the test.
Exactly. And the same applies to interest-only structures or bullet loans. The approval trail must explicitly detail the credible, verified strategy for how the principal will be repaid at maturity without relying on a forced liquidation of the pledged assets.
This represents a pretty significant cultural shift for front office teams.
It does.
The relationship manager basically has to pivot from selling a seamless liquidity product to acting as a financial auditor for their own clients. Which leads us to a crucial concept. Private banking is moving from simply drafting products to providing proof of decision quality.
Yes. Proof of decision quality is really the perfect operational summary of the EBA framework. Because when an internal auditor or a regulator pulls a credit file generated after November 2026, they are not just looking for a signed facility agreement and a valid pledge.
They want the methodology.
They want the documented rationale. They want to see the exact income figures used, the expenditure assumptions applied, the mathematical results of those sensitivity tests, and the final analytical conclusion that the borrower can comfortably service the debt.
Which brings us perfectly to our third core takeaway, aligning the documentation and the operational review. Because you can run the most rigorous cash flow analysis in the world, but if your internal templates and physical documentary records don't reflect those legal mechanics perfectly, you still face a compliance failure.
Right. The documentary record is the only legal proof that the classification and the capacity analysis actually occurred. The transaction documents must cohere across three distinct dimensions.
Okay, break those down for us.
First, the classification rationale. The file must clearly justify why the facility falls into the 1 to 100,000 euros consumer credit bucket versus an excluded category.
Makes sense.
Second, the repayment capacity analysis. The specific metrics, income, liabilities, stress tests, those must be hard-coded into the approval trail. And third, the physical documents must align with the classification.
Meaning the loan agreement, the pledge, the SECI pre-contractual disclosures, and the contractual rights regarding early repayment must all seamlessly match the requirements of the consumer code.
They must match perfectly. And from an operational standpoint, we must recognize that this requires standard operational parameters to be updated. It is important to frame this constructively, though.
Right. We are not describing some insurmountable operational burden here.
No, not a systemic failure of the lending model at all. This is simply the baseline requirement for operating within a highly secure, regulated European jurisdiction. Luxembourg remains highly attractive because it successfully integrates these complex private banking collateral practices with strict consumer protection standards.
But presuming that commercial appeal requires execution, lenders have to actively review their existing product catalogs right now. I imagine the immediate operational friction is going to be felt in those credit facilities hovering around the 80,000 or 90,000 euros mark.
Those are absolutely the immediate priority. Operations teams are currently running portfolio reviews, identifying standard templates that previously sat outside the 75,000 euros threshold, but will very soon be captured by the 100,000 euro ceiling.
They have to update the logic.
Yes, they're analyzing their standard operating procedures to ensure that the requirement for the SEC SI form automatically triggers for, say, a 95,000 euros loan. They are rewriting their credit committee approval forms to mandate the inclusion of the sensitivity analysis.
It's really about hard-coding the law into the origination software so the relationship manager cannot bypass the consumer protection steps. And that brings us to our third reinforcement of the timeline. November 2026 is the practical cutoff.
It is.
Every piece of consumer credit documentation, every internal underwriting manual, and every client-facing explanation must be fully aligned with the CCD2 parameters by that date.
It is an immovable operational target.
Which highlights a fascinating regulatory reality that I like to call the daily novelty rule. Because, in the legal sector, professionals often spend their mornings scanning the horizon for sudden policy shifts or breaking legislative news.
Always waiting for the next update.
Exactly. But on this specific topic, there is no daily novelty. There have been no structural regulatory surprises in the last 48 hours. The policy debates in Brussels are over. The text of the new Consumer Credit Directive is final, and the parameters are locked in. The market is entirely focused on the grind of execution.
The focus is purely on procedural conformity. However, there is a slight legislative nuance at the national level that legal teams are monitoring.
Oh.
While the European framework dictates the operational date of November 2026, the formal adoption date for Luxembourg Bill 8708 remains to be confirmed. If you check the Chamber of Deputies dossier, the bill is still technically in commission.
The parliamentary process is still grinding forward, but waiting for that final publication is a trap, isn't it?
It is a significant operational risk. Financial institutions simply cannot afford to pause their IT and compliance upgrades while waiting for the final legislative stamp.
Because the European text is already finalized.
Exactly. The technical requirements of the directive are already clear. The shift to the €100,000 ceiling is clear. The strict repayment capacity requirements dictated by the EBA are already established.
Right.
If a credit institution waits until the law is officially published in the memorial to begin rewriting its automated approval trails, it will inevitably miss the compliance window.
It basically requires building the necessary infrastructure before the final inspection is scheduled. You have to ensure the legal scaffolding is in place because the deadline for compliance is not going to shift just because a committee took an extra week to vote.
Precisely.
So, as we wrap up this clinical breakdown, I want to leave you with a specific practical thought regarding your own institution's internal data architecture.
The operational mechanics.
Exactly, the mechanics. We have detailed the rigorous legal requirement to prove a borrower's repayment capacity and the necessity of a pristine documentary record. But step away from the legal texts for a moment and look at the software sitting on your underwriters' desks.
Right, the actual user interface.
Exactly. When that €75,000 ceiling officially shifts to €100,000, how does your system react? Does the origination platform automatically flag an €85,000 loan request, lock the commercial workflow, and mandate the generation of a SECCI form?
Or does it let them proceed?
Right. Does your architecture rely on a human relationship manager to manually remember the new threshold and switch to a different word template? Because in a regulatory environment where proof of decision quality is the ultimate standard, the automated calibration of your internal systems isn't just an IT upgrade. It is the most critical compliance variable you face between now and 20 November 2026. Follow on Apple Podcasts, Spotify, or wherever you get your podcasts. Subscribe to Bertrand Mariaux and Rigor Media on YouTube. Connect with Bertrand on LinkedIn at bertrandmariaux.com. All links in the show notes. This was the Luxembourg Fundcast.